Are you a retiree still trying to pick individual stocks to fund your life? If so, you could be putting your nest egg at way more risk than you realize. For years, the textbook strategy was pretty straightforward. You buy a handful of blue chip companies, collect the checks, and enjoy your golden years. But in today's wild and unpredictable market, a strategy that once felt solid is now full of trap holes, leaving your portfolio dangerously exposed. What if there was a safer way, a more stable, less stressful method to get the income that you need so that you don't have to be up at night checking all the tickers and the times because it's hard to sleep wondering how everything's going to work out? In the next few minutes, I'm going to show you why thousands of retirees are flocking to a safer alternative for income and moving away from the roller coaster of individual stocks. We'll break down exactly why high dividend ETFs can offer better income stability and risk protection, and how this one shift could be the most important decision you make for a truly worry-free retirement. To be direct, the dream of living off dividends from a few great companies, it sounds amazing. It's actually very simple when you think about it. You do your homework, you pick some household names, you wait for the money to come in, but the reality for a lot of people is a constant low-grade hum of anxiety. Every market shakeup sends a shot to your portfolio, and you immediately end up turning on the news, looking at the tickers, going to Google, trying to figure out, hey, what caused the market to go down today? And then you're trying to figure out, do I make a change? Is it in my industry? Do I take advantage of this? That there's thoughts out there that say the market is on sale, I should buy more, but what should I buy? Because everything's not on sale, something is crashing, and something is going away, that we aren't really sure what those next steps look like. And so we just dealt with the Fed just announced that they were lowering interest rates. And when you look at the Fed lowering interest rates a quarter of a point, we have to take a moment to recognize that means the economy isn't very strong, that the economy is showing signs of a recession, signs of a depression, and the Fed is worried about that. So they're trying to lower the rates to keep us from going into a very deep recession. So just having that in the back of our mind, we're very much like, all right, what is the right next move? And in many ways, if you really think about it, it takes you from being an investor who just does it passively on the side to an active analyst who is reading and researching and predicting and putting the economic analysis together. And for many people, that isn't what they signed up for, especially if it's your retirement income. And the reality is the heart of the problem is what we call concentration risk. And that's when you only have, let's say like 10, 15, even 20, and kind of be pushing it a little bit, where those are the only amount of stocks that you have. It works very well for hedge funds because that's what they do for a living. And it is true that if you have a concentrated portfolio and all of your guesses are right, then you can win much bigger than if you build a diversified portfolio where you recognize that all of your guesses aren't going to be right. But that's okay because you're blending this average that gets you the goal that you need. Whatever that percentage return is that funds your retirement or that funds your passive income stream, that's what the number one goal is. We're not trying to get 20, 30% returns because if that's not required, then there's no reason to take on that extra risk. And when you look at hedge funds, that's why a lot of them disappear, where it's one today and then it's gone tomorrow, where they close down the fund and they reopen it at a new name, where they take the money and they get paid their 1% to 2%, and then that fund is gone within 5 years. That it is crazy when you really look at it, but that is the risk of having a concentrated portfolio where 1 out of 10 of your choices flops, and it's a huge problem that sometimes you can't climb out of. And in many ways, even when we're talking about blue chip companies that pay dividends out, and I often use General Electric as an example because that is a company that's been around a very long time and has a very solid history of paying dividends. But even General Electric is not exempt from the risk of a concentrated portfolio, because we recognize that General Electric in 2008, when we're dealing with the Great Recession, they had stopped paying dividends. And if that was the majority of your dividend income stream, then you felt in the worst possible economic time the pinch of not only your portfolio losing value, but the income streams drawing up as well. And in many ways, that's the unspoken, brutal truth about individual stock risk. A single dividend cut can torpedo someone's income and the value of your portfolio at the same time. You're then forced to sell other assets to cover your bills because the bills always keep coming. And we often have to do that at a loss, which increases the frequency at which we're burning through our money and our savings too fast. And that's why, in many reasons, the difficulty of all these moving pieces is why the fear of running out of money is the number one risk that most retirees have. The technical term that we'll often use is called sequence of returns risk, and for a retiree, it's the most dangerous risk of all. A big economic downturn or just a handful of bad choices when we built our portfolio in the early years of retirement, it can be devastating and very difficult to overcome. And it has a permanent impact on how long our money lasts. The idea that you can avoid this by doing the research, that's really oversimplifying things, and it's an illusion in many ways. That you can't predict a sudden corporate scandal like a Coldplay concert, or a global event like AI and how it's going to impact certain industries in positive ways and other industries in very negative ways. That if we're relying on a small handful of stocks, then in many ways that is a gamble. That is, if you're really not interested in putting in the consistent work of actively researching and staying on top of these things. If your goal is to be a passive investor, then we're really taking on too much risk. And retirement is no time to be a gambler. So if picking your own size feels in many ways like walking through a minefield, then you naturally are asking, all right, Dre, well then what's the armored truck to get me safely to the other side? And for a growing number of wise retirees, the answer is a high dividend exchange traded fund or an ETF to keep it simple. Think of it this way. My parents' yard has a ton of mangoes in it. I'm talking about like hundreds of mangoes every single year. It's absolutely crazy. Well, imagine if a single disease was to hit a particular type of mango, and then we would lose the entire harvest. In many ways, that is your income for the year. It's all gone. A high dividend ETF, on the other hand, is like owning a massive, professionally managed farm with hundreds of different kinds of fruits. So even if something happens to my parents' mangoes, they have the apples and the oranges and the kumquats, and they have all the other fruit, and there's plenty of fruit available to the point that they don't really even miss the mangoes. And I know that I'm being silly in a lot of ways, but that really is the power of an ETF that's built right into the fund. An ETF is a single investment that you can buy and sell just like a stock, but inside of it are dozens or even hundreds of different stocks. And unlike a mutual fund, which I won't get too technical in the differences, but an ETF is treated literally like a stock, which means that when you're ready to sell it, you can sell it. And that's any time of the day. That price when you push sell is the price that it gets executed at. But with a mutual fund, it's closed at the end of the day. So you may have seen something crazy happen at 10 a.m., but whatever the price is at the end of that day, that's the price that it gets closed out at. And for some people, hopefully you're not someone that's actively trading in that manner, but it is just a little bit of peace of mind of knowing that, okay, if something happens, I will be recognizing the price that I actually wanted to sell it at. And when you take advantage of diversification and allow yourself to have these exchange traded funds, instead of you betting your retirement on 10 or 20 companies, which is a little bit tougher when you're even just think about, all right, 10 or 20 companies, versus if you're able to spread the bet across a whole economy, like a whole sector of companies, then it's the single most effective defense against the company-specific risk that can wreck anyone's investments, especially retirees. The big idea here is shifting from a high-stakes, high-stress strategy to one built for stability and peace of mind. And let's break down the three main reasons why high-dividend ETFs are becoming the go-to choice for retirees looking for a passive income stream. We're going to build this around three key ideas: superior diversification, income stability, and radical simplicity. These aren't just buzzwords, they're about a fundamental shift in how you can generate income in retirement. So let's start with pillar number one, superior diversification, what I like to call the sleep well at night factor. We've already touched on this, but it's so important it deserves a closer look. The built-in diversification of an ETF is your number one shield against a catastrophic loss. When you buy one share of a high dividend ETF, you instantly own a tiny piece of every single company inside of that fund. Let's use a real world example. The Schwab US Dividend Equity ETF, ticker SCHD, is one of the most popular dividend ETFs out there. It holds over 100 stocks. When you buy one share of the SCHD, you're not just buying one company, you're buying a slice of giants like Cisco and AMB all at once. The rules that the fund is made by keeps any single stock from getting too big, usually capping them at around like 4% of the entire portfolio. Now compare that to your portfolio of 10 stocks where each stock makes up about 10% of your holdings. If just one of those companies cuts its dividends in half, your total income instantly drops by 5%, right? Half of 10%. That's a real hit. In an ETF like SCHD, if one of the 100 plus companies did the same thing, the effective income would be a rounding error, a tiny fraction of 1%. The blow is softened by all of the other companies that are still paying out the dividend. That's the beautiful math of diversification. Another great example is the SPDR portfolio S&P 500 high dividend ETF, or the SPYD. This fund takes the S&P 500 and invests in the 80 highest yielding companies. This gives you broad exposure across different sectors known for steady cash flow like real estate and consumer staples. With us being mindful of the fees and how they can impact our portfolio over time, the expense ratio is just 0.07%. That's an incredibly efficient way to get a wide diversification and a strong dividend yield, which is currently around 4.59%. This is the sleep well at night factor in action. You don't have to stress and worry about the fate of one or two companies because the income that you are generating is being generated by 80 different companies. And that leads us into pillar number 2, which is your income stability. And that really is the quest for quality. Diversification by itself is only half of the battle. The second pillar, income stability, comes from the quality of the companies inside of the ETFs. A lot of retirees do fall into that dangerous trap called yield chasing. They scan individual stocks with the highest possible dividend yields without asking, why is the yield so high? For wise investors, a sky-high yield is actually a red flag in many ways. It can mean that the stock's price has actually just cratered because the market thinks the company is in trouble and the dividend is about to get cut. This is where the best high dividend ETFs really prove their worth. They don't just blindly grab the highest yielding stocks. Instead, they use smart, rule-based systems to check for financial health and dividend sustainability. They act like a disciplined bouncer for your portfolio. Let's go back to the SCHD. It doesn't just look at the yield, its index screens for companies based on 4 key metrics. And those are your cash flow to total debt, the return on equity, the dividend yield itself, and most importantly, 5-year dividend growth. This process is designed to filter out companies that just look good today, but are actually in financial trouble and may not even exist tomorrow. It actively hunts for quality businesses with a track record of not just paying, but growing their dividends. Another ETF that really knocks us out of the park is the Fidelity High Dividend ETF, or the FDVV. Its strategy specifically looks at the company's dividend payout ratio and dividend growth. The payout ratio tells you what percentage of profits are being paid out as a dividend. If a company is paying out 100% or more, then it has no cash left to reinvest in the business, or, and sometimes more importantly, they don't have any cash left to survive an economic downturn. What we're saying is if your earnings per share is $1 and your dividend is $1, then that means that all the money you earned this year, you've given away as a dividend. And long term, that's not something that we believe is sustainable for the success of our retirement portfolios, which in many ways will mean that a dividend cut is almost guaranteed, like it's locked in. And so FDVV's screening helps you sidestep some of those risky companies. And it currently offers a solid yield of around 3.08%. This built-in quality control is something that's incredibly hard and time-consuming for an individual to do on their own. It provides a layer of security that you'll never really be able to get from just picking stocks off a best dividends list. The goal isn't just a high dividend yield, it's a high and reliable yield. And this brings us to our third pillar, and it might just be the most important one for your quality of life, and that is simplicity. Your retirement years should be for traveling and hobbies, spending time with family, going on adventures, not really for you to be squidzing in front of a computer screen analyzing quarterly reports. Believe me when I tell you, the constant work needed to safely manage a portfolio of individual stocks is huge and often underestimated by most people. With a high dividend ETF, the lifting is done for you. The rebalancing, the quality screening, the selling of the companies that no longer make the cut, it all happens automatically inside of the fund. This set it and forget it approach dramatically cuts down on the stress and gives you back the most important and valuable asset that you have, and that is your time. On top of that, ETFs are incredibly cheap. The expense ratios of many of the top dividend ETFs are astronomically low. We already mentioned the SPYD at 0.07%, the Vanguard High Dividend Yield, the VYM, and the SCHD both have expense ratios of just 0.06%. That means for every $10,000 that you have invested, you only pay $6 a year in management fees. It's a tiny price to pay for professional grade diversification. As the legendary investor Warren Buffett has said for many years, keeping your costs low is one of the surest ways to improve your long-term results. Finally, let's talk taxes. For many retirees, ETFs can be more tax efficient. Most dividends from US-based ETFs are qualified dividends, which are typically taxed at lower long-term capital gain rates instead of the higher ordinary income tax rates you'd pay on interest from a CD. This actually can lead to big tax savings, but you want to beware. It's not universal. Dividends from some ETFs, especially those that hold real estate investment trusts or REITs, are often treated as ordinary income. So it's always good to know what you own, but the general tax structure is a huge plus. The world of high dividend ETFs is huge. We just went over a handful of them just so you could kind of get the wheels a turning. But the good news is because there's so many options, there's probably something for almost every income investor. They aren't all built the same, so it is important to know the differences and what it is that you're being motivated by. What goal is it that you are trying to achieve? Is it the return? Is it the stability? Is it the tax structure? There are different choices based on what the goal is we decide. For ultimate stability, many people turn to the Vanguard High Dividend Yield ETF, the VYM. It's been called the Toyota Camry of dividend ETFs, and no, I did not think of that. But for those that did name it, the reason that it is named that way is because it's incredibly reliable, efficient, and it just gets the job done. It holds a super broad portfolio of over 500 large cap stocks. Its yield is usually a bit lower because of obviously the diversification. It lowers that average by lowering the risk. It lowers the return. It's like a trade-off. But it does offer currently around 2.5%. But with that, you get amazing stability, and it tends to hold up well during market downturns. For those wanting a higher yield without sacrificing the quality, funds like the SCHD and the SPYD are fantastic choices. SCHD is currently close to 4% with a 3.87% yield, and tough quality screening offers a great mix of income and potential growth, and the SPYD with its 4.59% yield gives you a bigger income boost by focusing purely on the 80 highest payers in the S&P 500. And for a smaller, slightly more risky slice of your portfolio, there are even ultra-high yield options. The Invesco KBW Premium Yield Equity REIT ETF, and that's KBWY for instance, they focus on small and mid-cap real estate companies and currently boast a massive yield of over 10%. Now that comes with a much higher risk and volatility, but it shows the range of tools available that you have at your disposal. By combining a few of these, retirees can build a diversified income machine perfectly tuned to their own needs for yield, growth, and risk. The move away from individual stocks and toward ETFs is a huge trend, and for good reason. It's about shifting from speculation to strategy and from anxiety to insurance. Now I want to hear from you. What are your go-to investments for income? Let me know down in the comments what your top 3 dividend ETFs are, or if you still believe in picking individual stocks. Your insights could really help someone else in the community. And if you found this breakdown valuable, I invite you to like and subscribe so you can learn how to create your own wealthy retirement system. As always, I'm Dre Griggs, founder of Obsidian Wisdom, where we help you have less worry and more wisdom. Until next time, stay safe and enjoy life.